Good morning, everyone. We're here to wrap up your long weekend and give you a jump start on the markets this week. Before we kick off, don't forget to click on that subscribe button and like buttons below. We have a wide variety of content coming at you, so you don't want to miss a thing that we're bringing out. We welcome back Brendan McCarty from Column E, waking him up from his long weekend. How are you, Brendan?
I'm great. How are you doing today?
Fantastic. Right, let's kick into this. A lot on the economic calendar this week with PMI prints, existing home sales, FOMC minutes, Q4 GDP revision, and core CPI prices as we continue to hear that word, inflation. I think we're all sick of hearing about inflation. So today we're going to dig into social media, another look at the sports and entertainment industry, a deeper dive in earnings for Walmart, Home Depot, and Fiverr this week. Plus, as always, we have our love it, like it, leave it. And we're going to look at Baidu, Wingstop, Nvidia, Teladoc, and Booking Holdings. All right. First off, I want to look at the announcement of the Meta verified model that was announced over the weekend. It smells and looks a lot like Twitter's model of a paid verified account for a monthly fee. The verified account will be for Facebook and Instagram, but unlike a Disney bundle, you will need to pay for the account separately. Meta's up nearly 44% so far this year, and I believe that this model will create a lot more revenue for them, but don't forget that Snap created Snapchat Plus, and that hasn't really helped for their share price. Brendan, do you like this new model, and can it be a big win for Meta? Or does this feel like they could be getting greedy considering how much they already make from users?
I would say that it's a split. So for Facebook itself, in terms of the blue check mark, I don't think it matters. Facebook is really about community more than anything. It's not a great advertising mechanism. Whereas IG is like Twitter. IG is a completely different animal. So you can see how the blue check mark might work. But honestly, I've never heard of fraud on IG. So you hear about it on Twitter, but you don't hear about it on IG because IG is so personal. It's like you see the people behind the video. I guess you could create a forgery of something, but in a way though, I don't know how necessary it is. Now, with that said, Twitter pushing through Twitter Blue was a great idea. It created instant revenue. The blue check mark, people rely on it, especially those who are writers. Like they don't want to be like slandered, or they don't want to put out stuff. They want to make sure it's their stuff going out. And IG is the same way. I mean, people will buy it because they're like, oh, I got to be verified. Well, I mean, IG is more pictures, so it's all about you. It's about the picture that you put out there. It's not like somebody could put a picture out there of you and copy it. But I think it's very smart in a way that these social media companies start trying to take advantage of these people that like to post over and over for free. Well, this is one way to get money from them. And when you have billions of users and you just get like 100 million, let's just say, from like Facebook alone, you're talking about a pretty decent revenue stream. Now, Meta itself makes a lot of money. So I don't know how much Facebook will bring to them. It's all about the IG side, I believe. That will be a profitable stream for them. It'll nice supplement to what they already do with the ad spending. But I don't know how much it will really chip into the ad spending, if you will. The ad spending is like all their business, right? And it's like passive, you have the feed through. So it will be an addition to the platform. But like for Snapchat, they put Snapchat Plus through. It hasn't helped their stock price at all. The stock's gone nowhere, if anything but down. And maybe that's a management thing. Maybe the management of Snap is just brutal, and they're wasting away all these young kids using their platform. I don't know, but it's a very good way to get money. It's a very good way to create a recurring revenue stream. It will not offset advertising. Advertising is just too much of a behemoth. I mean, they make billions and hundreds of billions and almost trillions. Well, not that much, but lots and lots of money on ads. They're going to make good amount of recurring revenue on this, but it's like Apple with their services. They have all these great services, but the iPhone still makes up most of their business. So it's one of those things where it will be a nice recurring revenue stream. I just don't know how much of a dent it will really make, but it's a very smart move, if anything, and it might continue like a trend of charging for everything on social media, and that might regulate it to some extent, where the frauds won't get on social media as much because it'll cost them too much.
Yeah, listen, it's probably a conversation for another day, like digging more into the data side of it, right? So I was looking at a report yesterday talking about Facebook actually doesn't take as much data as the likes of Microsoft, for example. It's they're making a lot of money there. A lot of people, it's not as if people are going to lose their accounts, right? It's like, okay, you don't have the verified side. So maybe it is more for the advertising side of it. Maybe it is for those vendors. Maybe that's something like Instagram, they have ads popped at you all the time. Facebook, I feel like less so, but it's, I don't know. They're obviously going to make a ton of money out of this. What, they've got 2.6 billion users. Like, even if it's 1% and they're paying over $100 a year for it, it's nice cash coming in. It keeps the payroll for a few people.
Yeah, definitely. I remember when Facebook first came public, and they said the moment they start getting their users to start spending money, it will be dramatic, because you're talking like 1 billion or 2 billion users. Whether they're all users is another question. But I mean, imagine you just charge $1 per person. Just say you generate $1 per person on 2 billion people. That's $2 billion in revenue just right there. So if you charge, say you get 10% of that, you get 200 million people to buy in at $11. What is that? 20 billion? Is that 2 billion or 20 billion?
Well, that's just a month.
Yeah,
it's
but that's
$14.
right. So it can be very powerful. Also, if it's targeted to pros, it's actually a relatively cheap insurance. Instead of going out to the insurance market and maybe getting social media insurance, if that exists, I don't even know. But this would be a cheap way that Facebook is basically insuring. I keep calling them that. Meta is basically insuring them that this blue check mark will protect them to some extent, right? So that helps them on the insurance side. Or at $11 a month, it can't be that expensive. That's pretty cheap for a company that's probably generating billions of revenue itself, like a Kraft Heinz. Or maybe they'll get people onto Instagram as well if they have the social media insurance, if you will. I don't know. It hasn't helped Twitter too much. It's kind of scared away their advertisers. But Twitter is also dealing with all assortment of other things that IG is just not. Like, IG doesn't deal with that controversial stuff. Just deals with IG with kids and models and influencers, right? Twitter doesn't really have that as much.
Well, free the nipple.
Yeah.
That's usually one of the things they go on about as well. All right, let's move on to the next part. Now, Brendan, busy weekend. Like, I love to watch a bit of sport. Did you see Manchester United beat Leicester yesterday?
No, but I watched Tottenham beat up on West Ham.
All right, let's listen. Some great stuff to look at. And last year we talked about opportunities in the sports entertainment space. And now there are headlines over the weekend that Elliott Investment is prepared to provide financing for the chairman of the Qatar Islamic Bank to bid for Man U, which he declared on Friday. Now, since we've talked about sporting teams last year, Man U's share price has been a very nice win for investors. Now we also look at WWE, and that falls under that sports entertainment area as well. And there's been a lot of takeover spec in this name for many years. But it is heating up right now, with Vince McMahon declaring over the weekend that he wants at least $9 billion in a potential sale, and that several bids have reportedly been submitted. At a $9 billion valuation, that represents a roughly 37% premium to Friday's close. It seems like a bit of a stretch to me, considering it some of the current price already factors in the takeover bid. Brendan, are the prices getting a bit stretched now in the sports entertainment space, or are we just getting at the beginning of this?
So to this question, there's two sides to this. First, with the sports valuations, I think they are getting silly, in that you're seeing certain owners, not like, for example, the Henry Group, which owns the Red Sox here and owns Penguins. They're not spending on Liverpool much anymore. And there's talk that they're going to sell Liverpool because they just can't stay with these other guys buying into the business. Well, what does that say about sports if you can't? I mean, like, baseball figured out they got a nice big TV contract where everybody gets lots of money, so they can all spend on their athletes. The Premier League teams are starting to find a little stress in that they can't go into the market anymore and go buy a Ronaldo, but maybe a João Felix a couple of years ago. Now he's with Chelsea. But I think that we're getting very stretched in terms of those types of franchises, in a way, because, like, Henry not spending is ominous to us. He spent, to me, he spent like over the last 10 years, he built that program up. Since Klopp arrived there, they built it up from nothing to a perennial power. Now they're fading because they're not spending anymore. Well, if the only way to win is to spend, this is it. That's not really it's not a stable business model. Like Tottenham there was talk this weekend that Tottenham might sell, and they don't spend a lot of money, and they're just struggling to stay in the top five, even though they did move into the four yesterday. And if you look at the Man U and their financials, they don't make a dime. They lose money every year. I assume it has to do with the spending on the players and whatnot. But then you look at WWE. WWE generates 1.5 billion in revenue, which is double what Manchester United generates, and they make $3 a share, which is what, thousands of times what Man U makes because they don't make any money. I don't know if that 9 billion is so unreasonable. I mean, maybe sports in this environment, I don't think it may be unreasonable as much, only because they make money. I didn't even know if they look at it. I didn't even look if they generate a dividend or not, but they make money. They're global in their reach. I mean, it's all silly entertainment. We all know it's fake, but the storylines are what everybody buys into. And you're spending $5 billion for Man U in evaluation, or if that's what they put it out for. $3.5 billion for Chelsea. I wonder why. What's the guys in New York? What were they looking for? Like $3 billion themselves, $4 billion, $5 billion, something like that. I mean, these numbers are insane, and I don't think any of these clubs make as much money as WWE does. Now, not the WWE owns their stadiums, but they make a lot of money, and it's hard to argue with it. And the fans own, I don't know, 70, 60, 70% of the company. So you're getting 60 to 70% of a $3 share. That's decent money to you. So I find it hard to believe that fake entertainment is worth more than real entertainment. But the numbers speak for themselves. If this is what we're going to start paying for sports franchises that earn nothing, why is it silly that WWE generates 1.5 billion in revenue and $3 per share? Why is it silly that's multiples higher than a sports franchise? And they are, in a way, a sports franchise, even though it's fake sports. So I can't believe I'm saying this, but maybe we're reaching a breaking point too. Maybe this is the point where these sports franchises, just like they were in 2000, and there's a lot of similarities right now to 2000 and today, where things just go sideways for several years, where the guy Elliott buys into it today and he doesn't see return on his money for 6 years. I mean, that's theoretically possible. I don't know.
Well, think about this one before we move on to earnings. Matt, picture this: oil. They do the deal. Elliott finances the guitar guy. We then go to an environment where oil goes to $10. You can't pay back the money. Elliott ends up as an owner of WWE.
Yeah.
Oh, sorry, Man U, sorry. Man U.
And it's like, I remember the baseball teams were selling like this in the 2000s. I can't remember who it was or what it was at the time, but there was these tech guys coming in buying these teams, or this famous CMGI stadium, right? CMGI puts their name on the Patriots stadium and goes out of business 9 months later. It's just, sports is hitting a breaking point. I said this we talked about this several months ago. Man U at $5 billion. I don't know. I mean, if it's an American, they're not going to like it. The English don't like the fact that the Glazers own it already right now. Why are they going to like another? I mean, and I know there's a lot of foreign money, a lot of Middle East money moving into the Premier League. But, you know, when, what's his name, who owned Chelsea, was not allowed in the country, what did that do for Chelsea's value? So there's a lot of political risk here. I don't know. There's going to be backlash against it too. I mean, they want English owners. Isn't there some rich English owner that wants to buy it? Sir something or other. I don't know what his name is, but he wanted to buy it too. $5 billion. We're hitting a breaking point. I'm pretty sure of it. WWE wanting $9 billion is just reflective of the current market. But is it really worth $9 billion? I mean, think of it that way, right? So it is what it is.
All right, let's jump into earnings this week, and there's some good names. Walmart reports pre-market on Tuesday. I'm seeing more and more Walmart ads on TV. I like them. It actually makes me want to go to Walmart. And they're also starting to eat away at Amazon. But the share price seems to be struggling to break out right now. So a few analysts predicting an earnings beat for Walmart this week. So could this be the numbers for the share price to break out?
It's an interesting story. Analysts are excited that they're handling the current environment. They're squeezing their suppliers. But the story is they're going to generate a lot of revenue and their margins are going to shrink. Is that a company you really want to own? I mean, I know they're going to raise their dividend, but Walmart is not getting through this environment that well. There's a lot of talk out there about store traffic. So relative to last year, the numbers may not be that rosy because 2021 was a year that everybody had all this extra money from the government. So 2022, they didn't. So the comparisons were harder. So the analysts now are bending over backwards to make this comparison versus pre-pandemic. And those numbers are slightly lower than 2019. So I honestly don't think it's all about the spin. The stock itself it's threatening to break out. So I'll give it that. But if you look at what's interesting is if you put it up against like foot traffic numbers, in January, Walmart's foot traffic was down. Target's was up. So what's that tell you? That says people with money have money and are spending. Those who don't have money are hurting or they're backing off. Now, what's interesting that I love talking about the grocery comparison, the Albertsons versus whoever. Albertsons, the contract, they kept the prices. They were able to control their pricing for a while because they contract further out. Well, I go back to my favorite two grocery stores around here. The contracted grocery store around here's prices are 20% higher right now than the non-contracted grocery store. So Walmart, I think, contracts well out because they're trying to get lower prices and they buy in bulk. I think Walmart's going to face a squeeze. I think prices are actually coming off in certain places, especially in grocery. I know Walmart, if they contract out, that's going to hurt them. Target, I don't know what they do for their supply chain. They've only messed things up last year. Their management screwed things over and over last year, so their stock suffered for it. If Target's traffic is rising, that means the consumer probably is doing better, but are they necessarily going to a Walmart? And that's probably why Walmart is advertising so much, because they're trying to steal it back. So I would just say this. There's only been a few periods over the last 20 years where Walmart's outperformed Amazon. In the last time, it was 2000, 2001. I think we're in the same point. Right now, Walmart is starting to outperform Amazon again. I would just say that we might be seeing the point where Amazon starts to rise and Walmart starts to fade. Walmart may start to rise, but it won't be behind. It will be behind the likes of Amazon. It will be behind the likes of Target, and the reason for that might be Amazon's more agile, less fixed costs. They don't have as many employees. I mean, they have a big delivery fleet, but they don't have people selling stuff in the stores. And Walmart makes up 85% of their revenue in the stores, only 15% online. So they still haven't been able to achieve that. So I would just say with Walmart, Sam's Club will be a surprise. They think that will be good. But I don't know how great the story is overall with Walmart. I think it's a slow-moving fixed cost storm that we might be looking in the wrong place. You might want to be looking at the Targets. You might want to be looking at the Amazons and not the Walmarts if you're looking at for the year ahead.
Yeah. Okay. And also on Tuesday mornings, Home Depot, and they report. Last week, I had some time off. I went through 8 states in 7 days. Everywhere I went, I saw construction of differing degrees, especially on homes. Any slowdown that we've expected on that front, I haven't seen so far in my traveling. I also think between Walmart and Home Depot numbers tomorrow, we're going to have a much better idea, sort of go on a feel of how the consumer is feeling in this environment. Looking at the chart of Home Depot, though, their share price doesn't want to go past 330, and it doesn't want to go below 305. Brendan, will these numbers give us some direction as to which way it could break?
So looking at Home Depot's chart, it looks like a loaded spring to us. The breath is getting stronger behind the scenes. Stock's holding above the 65-week. And we're heading right into the spring season. Now, houses are much more expensive to buy. So that's going to hurt the consumer in that when they buy their house, they won't have any money left to buy it, to add anything to the house because they just spent it all on the house. I digress. But the biggest thing for Home Depot is their Pro. That's what everybody's looking at. If the Pro comes in stronger, that means those who have money, which we're seeing at Target, which we probably will see at Amazon, those who have money are spending it. That means the pros will all of a sudden be spending it because they'll be doing remodels and whatnot. It will be an interesting report. Home Depot, while the stock is going nowhere, I think it's because the shorts are hitting it, keeping a lid on it. I don't have data for that. I have no idea. But based on the way Target behaved in the first month of January, I'm guessing Home Depot and Lowe's actually performed okay, not bad either, as we get ready for the spring season. So I think there's a story here that Home Depot will do better. Against those who have money are spending it, will go to a Home Depot, will go to Lowe's. It's a very discretionary product. Your lawn doesn't have to be green, right? But if you want it to be green, you go buy some fertilizer. If you want those windows fixed, not windows, but something that needs the creaky door. If you want a creaky door fixed, go to Home Depot, buy a new door. That's hardly discretionary. They've also done well on machinery. Higher machinery prices have been a tailwind for them. That supposedly those aren't going out of fashion because the farmers are buying up. Deere showed us last week that farmers are buying stuff hand over fist. This tells me that Home Depot might actually have a good report and a good outlook. I don't know. I think it might be a decent report.
All right, and then I've got an abnormal one for you. Fiverr, and they report Wednesday pre-market. And people watching, if you don't know what Fiverr is, it's the world's largest marketplace for digital services, and it offers buyers and sellers a digitally streamlined transactional platform. For example, let's say you want to promote a video on Instagram. Fiverr has people who offer those services at varying prices. Now, according to options data, their share price could move 13% or more after the earnings release. Short interest is at 7.91%, which is almost halved since September. Brendan, this is a volatile one, and that's an understatement. Other than volatility, what do you think we could see from these numbers?
So when I first looked at the chart, I'm like, it looks like a roller coaster, and it really does. It looks like it went up, and it looks like it went down. I think that short interest was covered in two reasons. It hit the bottom, it hit the 2020 levels. So I think that's a lot of people are covering from. And also, shorting stocks in this environment is not the safest thing for your health. This is a tough year. The last few years, January, February, has been really difficult to short stocks. It's like the meme guys just like look for shorts to run over. The retail traders, I should say, not the meme guys. I would just say that this is a fascinating stock to me. I'm not super familiar with it in that I've never been on it. But freelancing, as long as I've heard two good things about this. First, freelancing opens up it's the side hustle, right? You don't have to drive an Uber to have a side hustle. You just run a freelance business through this website and you start making money from your home, like you and I are talking on a video. This is very similar. They capitalize on it. Revenue, like Upwork hasn't been great, so that's their major competitor. So that might be a way, but the stock itself is turning. Now, what's interesting, I heard this from somewhere else, that they said that this company may actually benefit greatly as employment slows because people will need that side hustle. Well, let's go back to those who have money and those who don't. Well, let's look at it this way. If those who don't have money need a side hustle, this might be the option that they use. They can use, it's like Etsy with the crafts and stuff. Etsy created a whole world for arts and crafts people to sell their stuff online. Well, Fiverr does it for this sort of business, for streaming, for digital services. So this might have the future of Etsy. I don't know it that strong enough to say that, but Etsy made a whole world of crafts, and look at that stock. I don't know what it does these days, but it's public and it does okay. So I would say with the shorts covering, they see something turning. There's catalysts forming. Once we get out of January, February, it might be an interesting, different twist, but it looks like a real roller coaster, and it looks like it's on the upswing on the chart. That might signal that things are turning for the better. So it's going to be a really good read on the economy and how it's in transition.
Yeah, Etsy actually reports Wednesday after the bell too, so you might get a little bit of a read through beforehand.
Yeah, that's a good point.
All right, let's move it to like it, love it, leave it. Earnings theme here again, and the new viewers, it's a quick little look at stocks and things that are happening this week. And Brendan tells us whether he likes it or he's going to leave it. I don't get, we need more love in there, Brendan. All right.
Yeah, but I do love the segment.
All right. Okay. There we go. We put it all together. Okay. We're going to start with Baidu, and they report on Wednesday pre-market.
Leave it. Reversed under 145. I misread the chart when I was first looking at this. I thought it was actually above 145, but black candles on a chart mean lower. So I will leave it. Reversed under 145. Looks like it wants to go backwards towards 130. This will be a really good read on the China reopening, if it actually is reopening.
Next one is Wingstop. They report Wednesday pre-market as well.
This is a tough leave it. Stock's been strong. It ran to resistance at 175. I love my wings. I think a lot of people like wings. But it ran to resistance 175. Looks like it's reversing lower. It breaks out above 175. That could make it run.
Next one is Nvidia. They report Wednesday after the close.
Another chart that ran into resistance. Again, probably where shorts are lining up. It ran to resistance, so I would leave it. Ran to resistance at 230. Twin tops there on a weekly chart. 180 looks like is where it will go on a 65 week unless it blows out on earnings.
I put this one in for Matty because he had to do this last week. Teladoc, they report Wednesday after the close.
I like Teladoc. I've always liked Teladoc. I love the premise behind it. I don't know if the chart doesn't apply to my like of it, but I like this. I will say love it in this. I love the business concept of it behind it. I don't know what I like the chart. The turnoff of 23 recently was good. It's given a push, though it goes higher. I think the concept of Teladoc is fantastic, and I just don't know why it hasn't gained strength, but I like it.
Moderna, we haven't talked about this one in a long time. They report Thursday pre-market.
So is vaccines yesterday's news? I think that might be the story at Moderna, so I would leave it. As much as I like what they're doing in terms of finding rare vaccines for rare diseases, I think it's not there anymore. So I'd leave it. It's below support of 180. It's also in the 65 week. It looks like it's below that as well. So I would leave it.
And the last one is Booking Holdings, and they report Thursday after the close.
So this is a tough one because travel was really big last week, if I'm not mistaken. I would leave it. It's another one that looks like Nvidia and Wing, where they both hit resistance and pushed lower. I would leave it. Very tough one, and right in the face. You're going right into the face of travel with this one, but I would leave it.
Well, Brendan, listen, thank you so much for taking your time today. I know, like usually, they get a nice sleep in and a long weekend, and I've ruined that for you. Have a great rest of the day, and good luck trading out there this week.
You too. Good luck, everybody.
And for everyone else, good luck investing.